Hello, everybody. I'm Hugh Johnson. I'm the chairman of Hugh Johnson Advisors, and once again, I want to talk to you about what's going on in the financial markets and the economy to bring you up to date on some of our thinking of what's going on in this world of ours and why we're structuring portfolios or changing portfolios the way we're changing portfolios. I should start the start of the fourth quarter, of course, at the end of the third quarter, start of the fourth quarter. We had pretty much a bull market structure to most of our portfolios, all of our portfolios. In other words, we had a fairly meaningful allocation to stocks, and the stocks that we owned in portfolios, the structure of the portfolio had a bull market positive lean to them. And of course, we had that really difficult fourth quarter, and one of the things we say here at Hugh Johnson Advisors is one of the things we want to do is to respond to changes, trends, changes in the financial markets and in the economy as they unfold. We don't want to ignore them. So we did make some changes in portfolios, and most of you have seen that. What we've done, of course, is we reduce our allocation to equities, not a lot, but some. We've reduced most everybody down towards sort of the midpoint of their range. That's been an important step. And the second thing we've done is we've changed some of the individual issues in the portfolio. We reduced our allocation to stocks that are in the technology sector. We did that in October. We reduced our allocation to some stocks that had not performed well in 2018. We did that in December. We made a lot of changes in portfolios to do two things. First of all, to reduce your allocation, your equity allocation, and then also to, of course, change some of the stocks in the portfolio, the sector weights in the portfolio, so we became a little bit on the defensive side. Not entirely on the defensive side, but somewhat on the defensive side. In other words, shifting the allocation back towards targets. What we've done as we start the first quarter is we've seen, first of all, better performance from the markets. That's given us a little bit of an opportunity to kind of rebalance portfolios. You know, when you go through a bull market, things sort of get out of whack, and what we did is we put them back together in most portfolios. In other words, change the weightings of sectors in portfolios in order to get them closer to what might look like a market weight so that there's a little less risk in the portfolios. All of these changes were made, we think, and I'm pretty confident we've made really positive changes in portfolios. You may notice that when we shift back towards target, we don't have a real bear market bias at this juncture. That's not to say that if we didn't get further declines, significant declines in the market, that we wouldn't shift a little bit more defense or reduce allocation a little bit more. But right now we're sort of holding the line at target because we have a somewhat positive view. In other words, we think there's still a little bit of time left in the current cycle, bull market cycle, the bull market economic recovery interest rate cycle. Now we're well aware, as I've said to you in the past, that look, this is, as bull markets go, this one's a real aged bull market. This one's a long bull market. It's the longest bull market in history when you get out to 118 months, 119 months. The longest bull market in history, and that alone gets you on your toes watching really carefully for the so-called financial market performance and economic performance that might tell us that we need to go further in reducing your allocation to equities and preserving capital, which was what we really want to do, to preserve capital just in case things get a little more difficult in the markets. But we don't expect that, and we don't expect that right now. And the main reason is because the main reason we're sort of concluding that this is a correction, not the start of a bear market, is that it's really hard to make the case that this is a bear market and it's headed towards a recession, because it's hard to make the case for a recession. The consensus forecast right now is that growth for the economy will be around 2.6%, 2.5% for 2019, a little less than that for 2020, around 2%, maybe 1.9%. So that, but growth will be slower. It'll be slower for earnings, and as a result of that, of course, things are just not going to be that as exciting. In other words, growth rates are going to come down. But that still doesn't say a recession. The second thing is we look at technical things such as the yield curve, which allows us to quantify the probability of a recession starting in 12 months. That's still at 20%. That's still a low number. Yeah, it's getting a little bit higher. We're watching it really carefully, but it's a low number. And then the final thing, index of leading economic indicators, indicators that tell us where we're going. As I've mentioned before, they've been up 29 of the last 31 months. That's a pretty good record and suggests that the economy, when we look at those indicators, is going to continue to expand through 2019 and into the earlier part of 2020 if we're a little bit lucky. But even though we've got these positive signs that say this is not the start of a bear market that's going to be accompanied by a recession, we've got to watch really carefully. And if the markets were to tell us that indeed things could be worse than the consensus expectation, worse than our expectation, then we're not going to sit idly by. We're going to respond to those changes and reduce your allocation to equities. Looking ahead, again, I mentioned this is a long bull market. And I fully expect that if we get into the late part of 2019, we might see some problems in the stock market start to crop up, and they might be pointing towards a more difficult than expected economic environment and earnings environment in 2020. So we're well aware that that's a possibility, a very distinct possibility, and so we're going to be really very much on our toes. As I look to 2019, again, a positive outlook for the economy. I think inflation might be a little bit stronger than the consensus. Consumer inflation might get up to be about 2.5%, 2.4%. That might cause the Federal Reserve maybe to raise interest rates maybe one time in 2019. About mid-year, I expect the Federal Reserve will raise short-term interest rates, and other interest rates will go up along with it. That doesn't mean a whole lot for the stock market, except there'll be a little bit of downward pressure on what people pay for earnings, or price earnings multiples. That takes a little bit out of the stock market, but still, I think prospects for the stock market are probably still on balance a little bit positive. Really, the good news is we had that very sharp decline in the fourth quarter of 2018, and as a result, the market went from being overvalued of about 3% overvalued to being really seriously almost as much as 10% undervalued, and that's created a little bit of an opportunity and created a little upside potential for 2019. So we look at interest rates, short-term interest rates, longer-term interest rates, edging higher in 2019. The stock market may continue to edge higher in 2019. Having said all that, being somewhat on balance positive, we've reduced allocation to everybody's target or midpoint or toward that for most clients, and that's where we are. But again, very importantly, staying on our toes, watching the performance of the financial markets, all the details of financial market performance, all of the performance of important economic variables. I mentioned the leading indicators. We're watching all that very carefully in case it tells us that we've got to move a little bit further. Let's cross our fingers and hope, and I think it's a pretty good bet that 2019, first quarter 2019, second quarter 2019 will certainly be better than that fourth quarter of 2018. I look back at that fourth quarter of 2018 and thank my lucky stars that I'm looking back at it. But every now and then, as we all know, when you have as many good quarters as we've had and as good a performance as we've had in our portfolios, every now and then you got to give a little bit back, or every now and then there's a quarter which is a very disappointing quarter, a negative quarter, and we certainly had that in the fourth quarter. They don't come along all that frequently. Hopefully, again, I mentioned the first quarter of 2019, a good start. I think the first and second quarters of 2019 are certainly going to be on balance on the positive side. That's my guess. Watching closely. Thanks for your confidence. Give me a call. Give anybody here at Hugh Johnson Advisors a call. We really appreciate your confidence and really appreciate it when you call and give us your thoughts and ideas, your concerns. That's all very important to us. So thanks again for being such great clients of ours, and we really look forward to working with you in the future. Thanks very much.